following is a Silver Bullion television audiocast. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Today we have Mr. Ronald Stoeferle, a managing partner of Incrementum AG, an independent investment and asset management company based in Liechtenstein. He co-authors the well-known In Gold We Trust report with Mark Valek, which has become one of the benchmark publications on gold, money, and inflation. Ronald is a proponent of Austrian economics, and we're delighted to have him here today as our guest. Good day, Ronald, and welcome to SBTV.
Thank you very much, Patrick. It's a great pleasure. Thank you.
Thank you for being here. Ronnie, you've spoken at quite a few conferences, and I want to start by saying that I love your entertaining presentations, especially your presentation last year where you showed several pictures highlighting the difference between expectations and reality. And I think there was also one with two guys having a beer in a pool with an electrical wire going in there. And of course the Rocky Balboa music, really enjoyable, and I thank you for that. Now, you wrote your first In Gold We Trust report back in 2007. What made you interested in gold and silver, and what motivated you to write such a comprehensive report? I believe 2018 has some 200 pages.
Yeah, 230 pages. It's quite a brick. At least there's hyperinflation when it comes to the length of our gold reports. Back in 2007, I was a young analyst sitting in an Austrian bank, Erste Bank, and I always enjoyed investing in equities, in stocks. So I bought my first stocks when I was like 13, and I went through the whole dot-com boom and the dot-com bust, of course. I learned my lessons. And I've always enjoyed investing also in small caps. So 2006, I invested in a small gold mining company called Osisko Exploration, which ended up as a 40-bagger. And I honestly didn't have a clue about gold. I didn't have a clue about our monetary system, because that's not something that they teach you in school, especially not in business school. I didn't have a clue about Austrian economics, because that's not taught at all, even though when you're studying economics. So 2007, I went to my boss and said, I've got this gold mining stock. It's doing tremendously well, and I want to learn more about the sector. And he said, yeah, let's go ahead. And then I just wrote my first In Gold We Trust report, 2007. And then, of course, 2008, the big great financial crisis happened. I learned more about the Austrian School of Economics. I studied history. I studied monetary history. I studied hyperinflations. And I basically swallowed the red pill and started really understanding gold. I started analyzing it not as a commodity, but as a currency. And at some point I realized, hey man, that's not about gold only. It's about everything. It's about our financial system. It's about history. It's about politics, about geopolitics. It's about inflation, of course. So there are so many different angles to analyze gold. And I always thought, okay, I really want to deliver this holistic approach, so really analyzing gold from many different angles. So that's basically the reason why the reports got longer and longer. But I think that's also one of the reasons why this report is so successful, and it's probably one of the most widely followed publications on gold. I think people really enjoy the fact that we're analyzing it from so many different angles, and that we really want to do the deep dive into the topic.
Yeah, I'd have to excuse me, I'd have to agree with you there. When you're looking at gold, it's not just a commodity. You have to be looking at the economy. You have to be looking at technology. You have to be looking at political, geopolitical. There's so many other factors when it comes into gold. But last year, you opened the In Gold We Trust report with the line, "Gold is back." This year, the 2018 report uses the imagery of tides that are changing. Could you share with us more on how Mark and yourself came up with this concept of using changing tides to describe the central theme of the 2018 report?
Well, basically 2017 we said gold is back. We have seen the lows, and I think 2017 was a pretty decent year for gold. It was up 13.5% in dollar terms. It was up in basically every currency, but in the euro, on the euro basis, it was down slightly. And this year we said, okay, there's basically three big topics that we want to cover. So we said, okay, how can we best paint a picture and describe those dynamics? And that's why we came up with this picture of the turning tide. First of all, we're seeing the tide in monetary policy. We're going from a quantitative easing to a quantitative tightening mode. The second one is the turn of the tide in a global monetary architecture, de-dollarization happening at the moment. Just last week, the Russians said that they got rid of 50% of their US Treasury holdings. There's many signs, and I think we're going to discuss them later on. And the third tide is the tide in technological progress. Many people think that, you know, Bitcoin and all the cryptocurrencies are an enemy or an opponent of gold. From our point of view, there's great ways how to combine this old monetary technology called gold and new technology, blockchain technology, and so on. So it's not friends, but rather not enemies, but rather friends. So those are the three tides. And of course, in this year's report, we are also covering, you know, technical analysis. We're covering financial repression. We're covering mining stocks. We're writing a chapter about the failure of macroeconomics. We're of course writing about inflation and deflation, but the three topics that I mentioned are kind of the core of this year's report.
Okay. The first tide, impact from the change in central bank monetary policy. The first change is, as you mentioned, QE, quantitative easing, and quantitative tightening. Could you take us through on the insights in this first changing tide?
Of course. I mean, since the last big crisis, 2008 and 2009 happened, the biggest central banks, they created more than 15 trillion US dollars out of thin air. And of course, the markets got accustomed to this liquidity, to low interest rates, to cheap liquidity, to central banks that are very dovish. Now we have seen that the Federal Reserve is leading the way as always, and we're seeing that the Federal Reserve started their quantitative tightening as always announced, and they're on a quarterly basis they're raising their quantitative tightening program. So this is a bit the opposite of tapering, where they very cautiously reduced their quantitative easing program. Now they are very cautiously raising their tightening. So from October on a monthly basis, the balance sheet of the Federal Reserve will be reduced by 50 billion already. So this year altogether, the Federal Reserve will reduce their balance sheet by 420 billion. Next year, it will be 12 times 50 billion, so 600 billion, and then the year after also 600 billion. So this is quite a lot of money, actually. And it's not only the Federal Reserve that is becoming more restrictive. It's also the European Central Bank. It's also the Bank of England, the Bank of Canada. They're slightly becoming more hawkish, more restrictive. Now the thing is, people vastly underestimated the power of quantitative easing. From our point of view, quantitative easing and low rates are the main reason why we are experiencing this everything bubble.
Yes.
So it's not only ridiculous valuations in equity markets, in bond markets, of course, also in the art market, real estate all over the globe. This is mostly a consequence of this cheap liquidity that is spilling into the markets all over the globe. Now, if people underestimated the power of QE, I think they are in danger of doing the same with quantitative tightening. So nobody really talks about the consequences of quantitative tightening, but there will be consequences. And it's not only quantitative tightening, it's also the Federal Reserve raising rates, and interest rate increases have almost always led to recessions. So the historical evidence is quite overwhelming. In the past 100 years, 16 out of 19 rate hike cycles were followed by recessions.
Wow.
So what I want to say is, the 3 QE programs had quite positive effects on financial markets. Record low volatility, low price inflation, narrowing credit spreads, rising risk appetite, rising share prices, and so on. So from our point of view, QT will have the opposite effect, but markets are not really discounting it yet. And this is, from our point of view, the biggest driver, the biggest catalyst for crisis and or recession going forward.
I remember with the QE, when the US stopped QE, it was the day that Japan started. So kind of
exactly, yeah,
kind of a coincidental, let's say. But getting back to the excuse me, the everything bubble. Would you say that the bursting of the everything bubble can be expected anytime soon?
Yeah, the thing is, we per definition, we cannot really forecast what the pin is, but we also know the bigger this bubble is, the more fragile the whole bubble is, and the less it takes to pop this bubble. And there is lots of crisis triggers. There is of course a recession that will happen sooner or later from our point of view. And Patrick, nobody is expecting a recession at the moment for some reason. I think that's if there should be some sort of a shift in the market, this will have a significant consequences for valuations and for positioning in financial markets. So from our point of view, recession and or inflation, or perhaps a combination of both, stagflation, is a scenario that nobody is prepared for. So we just see that the fragile foundation of the financial market is showing the first cracks, and we have seen beginning of the year, end of January, beginning of February, spiking volatility, a little, let's say, crash in the equity markets, some troubles in the bond market. And I think it was really interesting to see that normally within the course of a crash, everybody goes back to the safe haven, which is US treasuries and the US dollar. But this year that didn't happen. So the US dollar was actually quite weak during that couple of days. So that might be a sign that this de-dollarization that we're describing is happening. But what is also really important to say, from our point of view, based on the Austrian School of Economics, a recession isn't something that people have to fear It is something very, very normal in a business cycle. It is something healthy for the whole economy and its structure, because it means a reallocation of resources. It means that companies that are poorly financed, that are poorly run, that have got a very weak structure, that those companies are taken out of the market, and that businessmen and companies that are more robust just pick the best assets, the best employees of those companies that are failing. So it's something very healthy. But what we should not forget at the moment, the number of so-called zombie companies is the highest in more than 20 years.
Wow.
Now, what's the definition of a zombie company? It's a company where interest expenditure is above the 3-year average of its EBIT. So even though we're having very, very low interest rates, there's 14% of the companies in the US stock market, they're having higher interest expenditure than their 3-year average of its earnings. So that already shows you that the structure of the economy of the companies is not healthy. And of course, rising rates and quantitative tightening are poison for this kind of weak structure of the economy. And that just shows me that sooner or later there will be a recession. And I mean, why is this sort of macro talk important for gold? Gold discounts that in the course of a recession, rates are lowered. There is fiscal stimulus. There is stimulus from the politicians. They try everything to shorten the recession. So actually, recessions are a great environment for gold. And that's why we are writing quite a lot about recessionary risks that are coming up.
So surely it looks like a recession is on the horizon with rising interest rates, which usually are a precursor to recession. And politicians don't exactly like recessions because they may not elect them back in office. Getting to the second change in global monetary order, which is the second tide, there is a visible shift where there are continuing efforts to turn away from the US dollar. Some like China and, as you mentioned, Russia, they're looking to internationalize their currencies. Could you share some examples of how the US dollar is losing its attractiveness?
We're writing about this de-dollarization already for 3 years, I think, and we're describing it at length in this report, because the de-dollarization is picking up momentum. As I've said before, Russia, for example, just recently said that they're dumping 50% of their US Treasury holdings.
Yes.
We have seen last year that many European countries, Germany, the Netherlands, but also my home country, Austria, were repatriating their gold holdings from the US back home. This also shows some, let's say, distrust in the system. And from our point of view, if you study history, you will see that the world leading currency that just changes. It's something quite normal. We have had the Dutch gulden, we have had the British pound, we have had the Spanish peso. Also, of course, Austria was a very, very important player in politics and in the economy back in the days. And now, basically, since the Bretton Woods Agreement, the US dollar was the world's leading currency. But this is kind of changing, and from my point of view, we are going to let's say more multipolar global monetary system. Now, there's quite a lot of signs, as we've mentioned, and I think it's no coincidence that there's basically on a daily basis new deals, new agreements between mostly emerging market countries, commodity exporters, and so on. We've got a great table in the report with the top oil net exporters and their pricing deals in Chinese yuan, for example. So we've got Saudi Arabia, we've got Russia, we've got Iraq, Canada, Iran, Kuwait, Angola, Nigeria, all coming up with some new agreements where they try to circumvent the US dollar and use their local currencies for trading. So it is pretty obvious that the world is, I wouldn't say that they want to dump the dollar, but they're just looking for alternatives. Now, we've got Jim Rickards on our advisory board, and he says if you want to play poker with the big guys, you have to bring chips, you have to bring plenty of chips, and those chips are golden. So it's no coincidence that countries that are gaining in importance, like China, like India, of course, like Russia, like Kazakhstan, like Turkey, that they're constantly buying gold. Russia just bought 600,000 ounces of gold last month, and it's no coincidence that the US still holds 8,000 tons of gold and that the Euro area, including the ECB, holds more than 10,000 ounces of gold. So I think the big blocks, the most important countries, they are realizing that gold is enormously important for the trust in a currency, and this is why they are holding gold in terms of the industrialized countries, or constantly accumulating gold like emerging market countries do. So from our point of view, we always said that the next big crisis, and probably this will be significantly bigger than 2008, the next crisis might lead to some sort of a monetary reform. I mean, that sounds a bit scary, but if you study financial history and monetary history, this happens every couple of decades. So from our point of view, every time there was a new system, new monetary system, gold played a major role. And I think this whole scenario is at the moment clearly lining up. Therefore, I would say, as I've said, I think the de-dollarization is happening. It's a long process, and we're right in the middle of that.
Yeah, I always hear all the time the term that the dollar as the world's reserve currency. There's another nail going in the coffin for it being the world's reserve currency. I don't think the world realized just how long those nails had to be and how many that there needed to be. The dollar, it's still surviving. Do you see this change happening within the next, let's say, 10 years or so, where the dollar is, let's say, dethroned?
Yeah, I would think so. I mean, 10 years... quite a lot can happen. Yeah, just think back 10 years and what happened since then.
Gold and silver were doing well 10 years ago.
So I think that can happen, but we should not forget that the US is still by far the most important player when it comes to the military and their power, and of course, I mean. Jim Grant said we are addicted to our reserve privilege, which is in fact not a privilege but a curse. So I think many of the topics that Donald Trump is coming up with now all those tariffs that are implemented and the trade deficits that he's seeing as an issue are also caused by our monetary system. I think we just have to, or the West or the US just have to accept its relative decline to emerging market countries. Yeah, I just returned from Kazakhstan. I'm often in Asia. I mean, if you then come back to Europe or the US, you feel like everybody is asleep or I don't know, on pills, because there is just no dynamic. And therefore, I think that the US, of course, knows, they realize what is going on, but giving up this privilege, this exorbitant privilege, that's not gonna be easy. And I think that I'm not sure if Donald Trump has got the right advisors, but I think, as I've said, those topics that are discussed so much at the moment basically are caused by the Triffin dilemma, and therefore I think that most of the problems that we're having at the moment have got their root cause on 15th of August 1971, when Richard Nixon, of course, ended Bretton Woods.
You mentioned the word multipolar. Could you explain about multipolar, and do you mean, is it something like perhaps a special drawing rights from the IMF where there's a basket of currencies, including gold?
Well, we know that last year the Chinese yuan was included to the special drawing rights, at only a very, very small percentage, but I think it was a sign. Well, the thing is, some sort of a multipolar trade system would be a big rearrangement of the current order. I think, as I've said before, this is happening in very, very small steps. I am really not sure if the SDR would really something, if it would be introduced, if it would be something that people would really accept. However, we should not forget that the IMF holds more than 3,000 tons of gold, and they have got a very kind of clean balance sheet. So normally, if you study the last crises, we always went from stage to stage, yes. And we have already seen in the last crisis that there was a big coordination between the central banks. I mean, those guys are meeting on a regular basis at the Bank for International Settlements in Switzerland. They talk about the issues, the problems, and probably also about the solutions when the shit hits the fan. So I think that special drawing rights, which is a horrible word in German, it's Sonderziehungsrechte. I mean, it doesn't sound really appealing, so nobody really will understand it. But I think that if there's really a big crisis, and you know, if there's a crisis, if there's panic, if there's huge volatility, if everybody is freaking out, that's the point in time when you want to introduce new stuff. It's right. I don't know who said it. I think it was Hillary Clinton. Never waste a crisis. So I think that it might happen that some sort of special drawing right might be introduced in the next crisis. And the special drawing rights, we should not forget, it's even more let's say opaque than pure fiat money. It's I think a friend of us, Peter Miller, he said money used to be I owe you gold. Then it was I owe you nothing, which is fiat money. And special drawing rights would be who owes you nothing. So, I mean, I think that that special drawing rights might some be of a solution. We wrote about it in the last couple of gold reports, because, as I've said, the next crisis will probably a currency or a monetary crisis.
Yeah, it's still on YouTube. All anyone has to do is go back, and they can see that in 2014, IMF head Christine Lagarde, she did say that there was going to be a global currency reset. So it's on record that the IMF has already said it. And as you said, the thing with the IMF, I didn't vote for anyone in the IMF. How about yourself? Did you vote for anyone in the IMF?
No, not really, but I didn't vote for anybody at our central bank either.
Exactly. So exactly, and these are the things where these people in charge of our financial system or our money, they are not obligated to us in any way.
Totally agree. Absolutely agree.
Ronnie, when this global monetary order change happens, do you think it will be a chaotic time? And as you mentioned, there has to be some sort of an event for these things to happen.
Yeah, no, you normally don't implement something big when it's just business as usual. Just remember those crazy weeks in 2008 when Lehman went down, when AIG, Freddie Mac, Fannie Mae were collapsing. I mean, they were introducing big packages, and I think nobody, not central bankers, not the smartest Wall Street bankers, nobody knew how it's gonna turn out. The interesting thing is, on average, we've got some great charts on that. On average, in the course of a recession, rates are lowered by 500 basis points. At the moment in the US, we're slightly below 2%. In the Eurozone, we're still basically at zero. So the thing is, what are central bankers gonna do if the next recession hits? That's the big question. And Jean-Claude Trichet, the former head of the European Central Bank, he said that if the next crisis happens, there's basically not too much in the, let's say, toolbox of the central bankers. Because back in 2008, it was possible to introduce quantitative easing for the first time. Everybody nobody knew quantitative easing. Okay, that sounds interesting. What is it actually? They lowered rates significantly. They came up with fiscal stimulus. It worked, but now balance sheets are pretty much stretched. Yeah, we're seeing this over-indebtedness not only in the industrialized countries but also in many emerging market countries. Just to give you one number for the US, the Congressional Budget Office, they expect that the total deficit in the US in the next decade will be roughly 14 trillion US dollar. But that's given the fact or under the assumption that there will be no recession in the next 10 years. So if there's going to be a recession, it will probably be 20 trillion US dollar of new debt. So they simply cannot afford higher rates, higher real rates. One has to say. So that already shows you that there's not too much leeway. On the other hand, we are really not sure how the banking system would react to negative rates. My special friend, Mr. Rogov, he's quite vocal when it comes to, abolishing cash, and we've got some customer reviews for his book, The Curse of Cash. I think it's pretty interesting, because I think people they don't like this idea of abolishing cash, but those guys, they see it as one of the main solutions, because if you still have cash, you cannot introduce massively negative interest rates. And as I've said before, normally in the course of a recession, rates are lowered by 500 basis points. So we would have to go into deeply negative territory in the next crisis. And this would be lethal for the financial system, for banks especially. So what can we expect? Probably more capital controls. I think central banks will also buy equities. They will basically buy everything that's everything possible, a bit like the Bank of Japan does. We should not forget that's a bit of the blueprint probably is Japan. They're already having their 11th or 12th round of quantitative easing. They basically completely socialized their financial system, and therefore I think that we should expect some really, really drastic measures in the course of the next crisis.
Yeah, I'm hoping going cashless is not one of them. I'm not a fan of going cashless simply because it wouldn't take much for a corporation to lobby a government and say, hey, there's too many smokers out here. Our costs for treating lung cancer is too high, so we have to limit people to, let's say, how many cigarettes they can buy. And then when you go to a store to buy cigarettes, being cashless, if you show them a card or whatever it is, they scan it and they're going to see, oh, sorry, you're not allowed to buy any, no cigarettes, no alcohol for you, or whatever it is, and you can't do anything. You have no cash to buy.
Absolutely. I mean, I think that people and entrepreneurs are always one step ahead, so there will be solutions, but normally this will make everything more expensive and more complicated, and of course I mean the whole crypto space,
Right.
from our point of view, is basically the answer or a consequence of our kind of surreal monetary system. I think that people are getting interested in Bitcoin, in all the other cryptocurrencies. That's basically a consequence of this growing distrust in the fiat system. And if you read, for example, the white paper by Satoshi Nakamoto, he understood the monetary system. He understood how gold works. Yeah, he basically structured Bitcoin and its stock to flow ratio quite similar to gold. And I think it's no coincidence that you are mining Bitcoin, and that the logo of Bitcoin reminds us of a gold coin. So
Right.
People often refer to it as digital gold, and I think there's actually quite a lot of similarities
Yes.
between those two technologies.
Yeah, and that actually takes us to the third tide, which is technological revolution or digitization of money. And we are seeing things like Bitcoin getting very popular, cryptocurrencies getting very popular. Last year they did well. This year, not doing so well so far. But where do you see cryptocurrencies going from here to fulfill the third changing tide?
Well, I have to say that we've got a sister report of the Gold Trust report. It's a quarterly report called the Crypto Research Report. It's also for free, and we've hired one of the leading experts on cryptos, Demelza Hayes, who's in the crypto space for many years already. She's much younger than I am, so she knows the whole crypto space very, very well, and she understands the technology much better. From my point of view, from a philosophical point of view, I really love the fact that people are now discussing money again. They are discussing if Bitcoin is money, if Bitcoin is better money than gold, the euro, than the dollar, on Twitter, on I don't know, on Reddit, in message boards, when they're sitting down at meetups, at conferences, so on. I think this is a very, very important discussion that's going on at the moment. And besides that, I think that, of course, cryptos, they kind of stole the show from gold.
Sure.
We
Yes.
all know that if you're a journalist, you basically have to sell your story. And in the last couple of months, of course, it's much more kind of sexy to write, okay, Bitcoin is going to 50,000, than writing a story about gold basically going sideways. So there was lots of media attention and also lots of speculation coming into the sector. And I think this was kind of shaken out the last couple of weeks. And don't get me wrong, I think most of the altcoins that are around, most of the projects that we're seeing popping up are rubbish, and they won't survive through the next couple of years. Sorry. But there is enormous technological progress happening. The whole sector is soaking up resources, not only financial resources, but really quite a lot of talent, human resources, is going into this sector. So I think now also the big players have realized that this is not something that just comes and goes, but this is really a revolution happening. And I mean, don't get me wrong, but a normal bank, I think for a millennial, they probably don't know how to spell the word bank. They've never visited a bank because they just don't need it. So I think we are seeing a revolution of our monetary system, of the banking system, of the financial industry. And at the end, there will be fantastic solutions for us as customers. There will be fantastic opportunities for entrepreneurs and investors. So I'm very, very open when it comes to crypto, because it's just, it's competition, and competition is always positive for the market.
Yeah, I think the besides the word bank, the other word that millennials might not be able to spell is hold. Apparently, they spell it HODL. So, but Ronnie, let me ask you: cryptocurrencies, are they a safe haven asset class that people can defend themselves with from currency depreciation?
Well, I would say, I mean, if you study a long-term chart of Bitcoin, absolutely. If you have a look at a more short-term chart of Bitcoin, well, it hasn't been the best investment. And for us, we are about to launch one of the first funds in the crypto space. For us, it is a very low or even negatively correlated asset class. It's an asset class that can easily be I don't know, 5 to 10 bagger, because it's still, what's the whole market cap of the crypto space? I think at the moment Bitcoin is at 100 billion. Of course, that's a number, but compared to many other currencies, compared to many other companies, that's still pretty tiny. That the second biggest Ethereum is at 40 billion, and then Ripple at 18, and then so altogether the market cap of the whole sector is probably 200 billion. Can it be a 10 bagger? of course. Is there massive downside? Yes, but I think that there's been quite a lot of liquidation going on. I think we're in a kind of a crypto winter, as we wrote in our last crypto research report. I think we might be really close to the lows. So I think this this rally will have legs, and I think from a more philosophical point of view, it is really interesting. As you know, I'm not only from Austria, but I'm also a follower of the Austrian School of Economics, and Friedrich August von Hayek, he was basically writing quite a lot about the market structure, but also about competition. And he said, he wrote in a denationalization of money, he wrote, the history of government control over money is, with the exception of a few fortunate time periods, a history of unceasing deceit and fraud. So Hayek, in his denationalization of money, wrote already about private currencies, about currencies and money that is issued by private players, by companies, and so on. And he said that basically everywhere competition is a good thing, and we let it happen, but why shouldn't it be positive in the currency space as well? And we're having a great interview with the nephew of Friedrich August von Hayek, who is also one of the world leading experts on Hayek, and he said that Hayek, if he would still be alive, would be very open to the whole crypto revolution. But at the end, he says, I believe it is still fair to assume that Hayek would prefer gold to cryptocurrencies, because one of the main problems, of course, is this enormous volatility that we're seeing in the crypto space. But this will change if the market adoption is becoming more important. But as I've said before, I'm seeing it as something very, very, very positive.
Okay. Earlier you had mentioned that gold and cryptos, they can actually be complementary to one another.
Well, we're describing quite a lot of projects that are currently launched, and I think there's, for example, the biggest mints, the Perth Mint, but also the Royal Canadian Mint, the British Mint, the UK Mint. They just came out with really, really good projects combining physical gold and blockchain technology. So this is something that is kind of starting at the moment now. That is something that is basically just beginning, but it is something that has got plenty of room, because the thing is, I think that the whole gold space, it was not very, very innovation friendly, let's put it that way. Peter Grosskopf, he's the CEO of Sprott. They just came up with a great product, Tradewind Markets, which is a technology provided by Sprott, Goldcorp, and IEX. And Grosskopf, he made a good quote. He said, every year since the 70s, gold has lost market share to financial assets, and I think this gives it a chance to come back against those financial assets. And therefore, I think that if you make gold more appealing, more sexy for millennials, if you make it more convenient to buy, to trade, to store gold through this new technology, I think that there will be enormous new physical demand for gold. And we know that there's quite a big discrepancy between the physical and the paper market, and at some point that's kind of might break. So I think this new physical demand that is coming from those projects might actually be a big price trigger going forward. But as I've said, it's still very, very early.
Right. How about yourself, Ronnie? Do you own any cryptocurrencies?
I own some, yeah. As my wife would always say in December, why didn't you buy more of those Bitcoin? No, I own some, yeah, but I'm following the space, but
Yeah.
of course, I still prefer gold to cryptocurrencies because I just understand it better, and
Yes.
I simply don't have enough time to study all those projects, understand the people and the technology behind. So I think one very basic recommendation should always be, when it comes to investing, only invest in things that you really understand. And I think my main expertise is just in the gold market. So therefore I'm sticking to that mostly.
What we see is one of the issues with crypto is private key protection, and in some ways it seems to be an impediment to the adoption of cryptocurrencies. Are you seeing that as well? People wondering how to best store their keys, and maybe how do you store yours?
Storing the keys is an issue, but I think there's great solutions coming out. We have seen that also the exchanges, they became a bit more secure. We haven't seen any big scandals like Mt. Gox and all the other ones recently. So I think that's the sector with the higher market adoption is getting more secure, and I think there's when it comes to wallets and to storage, I think also insurance, there's some really good solutions out, and of course, with rising adoption and more people entering the space, I think that we will see better, more convenient, and also cheaper solutions coming out.
Okay. Ronnie, absolutely interesting with all the things that you have to say. Could you let our listeners know how they can access a copy of the In Gold We Trust report?
Of course. Well, it is totally for free. We have got a new webpage just for the report. It's ingoldwetrust.li. You can download the report in German and in English. We've got a short version, which is called the compact version. It's roughly 50 pages. And as you know, the long version has got 330 pages, the extended version. And you can download both on ingoldwetrust.li. You can follow me on Twitter. I'm very active on Twitter, tweeting out charts and my comments on the gold market. It's Ron Stoeferle. And yeah, all information about our company can be found on our webpage, incrementum.li.
Could you share with us what Incrementum AG does besides publishing the report?
Yeah, well, we've got three main businesses. It's research, the gold report, as well as the crypto research report. The first one. The second one is wealth management for high net worth individuals. We are based in Liechtenstein for a good reason. It's one of the safest and most secure jurisdictions in Europe, a bit like Singapore. So it was no coincidence that we chose Liechtenstein. It's just a great place to do business, especially in the financial service industry. And the third business that we're doing is asset management, so fund management, where we're managing 5 funds at the moment, mostly in the commodity and precious metal space.
Okay, great. We're going to absolutely point our listeners in your direction. I think the information you have, it has to be looked upon. It's tremendous stuff. But Ronald, we thank you for coming on the show. It's been an absolute pleasure speaking with you. And one more time, how do we pronounce your last name?
If you want to say it really correctly,
yes, we do.
It should be Stoeferle.
Stoeferle.
Yeah, that was perfect, Patrick.
That was Ronald Stoeferle from Incrementum AG and the author of In Gold We Trust report. For more of his insights on precious metals and the global economy, please visit his website www.incrementum.li. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content.